Right. Well, thanks for being here. Got a lot of cool things. I know a lot of you guys are familiar with calendars and how they work, but if you're not, you are in for a treat, I think. Um, I like to trade. As we get into it, you'll see why. First, we have to put the disclaimer up there to keep the legal people happy. So with that, we're not going to talk about specific trade setups here, so I guess we don't really technically need it, but or I'm not going to give any ideas, because this will be recorded. But today, again, thanks for joining us. Why are we here? We all know, we've seen, what's been going on in the market lately. Crazy, wild swings. There are many ways to take advantage of that, right? And over the years, some work better than others. I've tried everything out there. For you guys that don't know, I know we do have a lot of new people joining, and I did want to mention I've been trading professionally for 31 years now, and again have tried everything out there. And when we get into a market like this, especially when we get into a kind of a violent market, I guess, is for lack of a better word, and on the upside we can be violent as well, right? That's what's been happening lately. We need to know how to take advantage of it and when to use which trade and that type of thing. So that's what we're going to talk about tonight. So I see opportunity in this, and I tried to think of a title for this, and if you guys have been around for a long time, you remember Greenspan, irrational exuberance. That's kind of what it feels like right now. And if you even for people, it's funny, even for people, when you go to a cocktail party or whatever and you're talking to people, people that don't even trade, have no idea what the market is doing, will say, wow, the market's been crazy. And it has, we know, to the downside and then to the upside. And to one step further, I'm sure this has happened to you guys before, not so much lately, but two months ago, people would say, oh, the market's just getting killed, and they didn't even know it rebounded 300 points or whatever at that point. And it's crazy. But the wild swings that we get create volatility changes, and there's a couple of ways to take advantages of opportunity or of volatility, from premium selling to calendars to diagonal, so forth. That's what we're going to get into. So I think the best way to do it is through calendars, right? And different strategies have different structures. They have different, there's a different edge in different types of trades, different opportunities. No one can ever predict market direction all the time. We may be right some of the time, but again, you have to be able to know which strategy to use. So we use long calls, puts, debit spreads, so forth directionally. We use credit spreads, iron condors, maybe non-directionally, butterflies, diagonals. And diagonals, they're kind of the cousin of the calendar, but that's a different animal. So we'll stick with calendars. But all of the strategies are good. We use them all. And you have to know when to use each strategy and which strategies complement each other. That's a huge component of it in a portfolio stance and on a longevity stance in your trading career or endeavor, right? Because it's pretty rare that we only have one type trade on. We're going to have multiple type trades on. So we need trades that complement each other rather than overlapping. And that, for you guys that manage by the Greeks, or anyone that trades on a portfolio level, you will know that you can run into a lot of trouble, risk, pain if you get too long or short, delta or vega or any of the other things. And even if you don't know what the Greeks are, you know what that pain is when you get all one directional, right? So that's what we're going to kind of drill into a little bit tonight. So what do we all want out of a trade structure? And I always try to emphasize the trade structure. And for you guys that have been trading with me in bias and in the main room, that I'm all about kind of mixing and matching trades and trade structure. It's very important because that gives you flexibility to kind of twist and turn with the market rather than being the punching bag on the other side, right? So we want trades that are easy to use, easy to understand, not complicated. We want a trade that's repeatable. Of course, we want that, lather, rinse, repeat kind of trade. Everybody wants that. We want a trade that's scalable, right? We want something we can use one contract or 10 or 100, it doesn't matter. And it will be essentially the same trade. Not all trades are like that. But most importantly, we're all looking for consistency. And again, that's why we're here today, because I want to talk about really what's working, what's working now. The calendar, of course, you guys hear me mention it all the time in all different kind of market environments, but especially lately when we are, running pretty fast up to the all-time high again, vols are dropping. This is we're getting into calendar weather, calendar season. And I definitely want to share this with you guys. It's worked for many, many years. It's probably, honestly, if I went back and looked, it's probably the first option trade. Even before a long call or spread, I probably did a calendar first. And that is from the standpoint of, the reason is from standpoint of it's a gentle trade normally. So it's kind of hard to blow it up, right? It's typically a slow moving strategy, very simple setup, simple trade management, right? That would make a huge difference in your P&L if you had a trade like that, right? And you got, I know a lot of people use them, and a lot of people probably don't. I hear some people say, well, they're too slow or whatever. That's a good thing, right? If you had a strategy and a structure like that, that could make a huge difference in your P&L, huge difference in your stress level, that you don't have to have as much a direct attention on the trade all the time, right? But it comes back to the question, who should be using calendars? And I can tell you, professionals use calendars, right? They may call them time spread or a different name, but they're calendars. And I can prove it because most of you guys probably know I went to the CBOE, Chicago Board of Options Exchange, the Risk Management Conference 2 weeks ago in California. And risk management conference is for institutional hedge fund managers. There were about 250 of us there, and literally the title was, everything about the conference was risk management and hedging, right? There was one section that these were all the top guys, right? And the speaker comes up and he's talking about hedging, and they're doing this and this and this, and these guys are managing billions of dollars, literally billions. And the concept of the calendar comes back to, well, we want to buy these long options, right? Well, how do you pay for those? Well, you sell shorter dated options against the longer dated options, right? That concept's been around since day one, because it's simple. How are you going to offset the cost of this expensive option? So he goes into the analysis of what they're doing on a much larger scale, obviously. And I'm thinking, this is just a calendar. That's all he's doing. We're buying July and we're selling May against it or whatever, Now, there are some pretty dramatic variations you can get on the calendar, and theirs were a little more advanced, but at the heart of the trade is the calendar. So, and again, that was 2 weeks ago. I'm telling you, I've been using them for 30 years. It is a go-to trade, if not, kind of the core trade, I guess I would say. So if you're newer to trading, you need to know it, right? If you're advanced or you've been trading a while, maybe you haven't used them in a while or never really used them much, you should really consider them, especially in the more advanced type uses that we can do, because it's a super flexible trade. You've got to at least, you have to at least try to fit it into your toolbox, right? It's a multi-purpose tool. We all have trading toolbox, whether you want to call it a golf bag or a toolbox or whatever. I've used all kind of different analogies to, you have different trade strategies for different times, right? It's just another tool in the toolbox, right? So again, what do we want to do with that tool? Well, we want to use it for opportunity on price and volatility. And you will hear people say, that they trade volatility. Well, there's different ways to trade volatility. I think the calendar's the easy way to trade volatility, right? So most of our trades, I would say for the most part, people trade price. We have a squeeze on something and it's firing long or it's firing short. We're buying long options, or debit spreads or whatever. For the most part, we trade price. I kind of grew up on the trading volatility side from selling premium to, all kind of different variations there. But the calendar is a way to trade volatility in the simplest form. Very, very easy. Calendars take advantage of price and volatility because the way we can structure the trade, right? 2 ways to win on one trade. That's pretty good. Doesn't get much better than that, right? So why does it matter? Well, we all are we have to be aware of volatility in the market, in our positions, et cetera. I put up here, think about the VIX. I mean, why do you think we have the VIX, the volatility index, right? So when higher, periods of higher volatility, we want to be selling options in general. Lower volatility, we want to buy options, but it's not always easy. It's not always straightforward, and it's not always best, because when the market is, really, really selling off hard and vols spike up, you're stepping out onto some thin ice, selling that volatility. But you can do it in a much more contained way, through a counter. You can harness that price and volatility in one trade, right? So always be aware of that. All right. So I get this all the time. People will say, well, it's a neutral trade, delta neutral trade, or however you want to phrase it, neutral trade. It is, in most cases, the most common use is a neutral type trade, which is a good thing. That's not a bad thing, right? And it started out as a time spread. You have 2 different expirations in the calendar, time spread, and then it kind of grew or evolved into a calendar spread, because people would say May, June, July, August, December, whatever, from time spread to calendar. But again, been around since the beginning, right? Neutral, in the neutral sense, you're just collecting theta, right? Range bound, market's not going anywhere, or stock, it's not going anywhere. Very simple, right? But over the years, I've tried to vary the trade, and it works, to improve the setup to be a bullish or a bearish setup, right? And that's one way we can really take advantage of volatility in the way that we set up the structure of the trade itself. So we can vary our time frames, we can vary our strikes up or down. We can really, really dial it in using volatility, if you know how to track the volatility and when to use it. The other thing too, most of the time, you guys probably see me trading it on the indexes. I use SPX and RUT primarily. You can use NDX. I like that. It's expensive, but I like it. But I also, any stock out there, any ETFs, very, very, very flexible, and the structure is basically the same. On a lot of the trades, it's not. If we use a butterfly, I may use a completely different structure for a weekly than a longer dated trade. On a calendar, it's pretty much the same, right? So very, very, very flexible. So I wanted to go through some examples and show you guys kind of what has been working lately and kind of what I'm looking for. So let's start with the RUT. And I believe this one, I believe this one was in an email that was sent out. This one started on, I think, 321. I think it's on the next slide, but I think it's 321. But what I'm looking for here is a kind of it is in this scenario, I'm looking for a lower entry vol right here. And so I entered the trade, and I don't have exactly, but I'm looking for this range of trade here, and this range would be fine. This range would be fine. This range would be fine as we're stair stepping up. Even this is okay on the downside. If you're structured properly, this is a gold mine, but any of this, any of these kind of areas will work. And that's the cool thing about it, is you can structure it in kind of any market environment. Now, obviously, when things get really crazy over here and vols coming up right here, we may want to use a different type strategy, but we also may want to use multiple type strategies to offset the risk in the other strategies. In other words, some are positive, some are negative, so forth. But in this case, this is my time frame, and this is my volatility frame that I'm looking for. So in this trade, the entry was on 3/21, and I did an April-May. I don't know how many days expiration this was. I can't remember, but anyway, 3/21, and in 22 days, it was $1,180. And again, think about this for a second. A lot of people might say, well, that's decent money, right? But I'm in the trade 22 days, man, that's a lifetime, because I know a lot of people scalp and day trade, and you're flat at the end of the day and all that kind of stuff. And that's great. I do it too. But I want something that I can park on the back burner and not have to watch. That allows me to focus on the short-term day trading. If you want to scalp futures or whatever you're doing, you got this working in the background. And I will also layer these things on, so it's not put one on 22 days later, take it off and put it on. Maybe I put one on this week, one on next week, one on next week. So as they're coming off, maybe you're making $1,100 a week on it. There's a lot of ways to do it, right? You could size it up or down. This is only 4 contracts here. On the indexes, they're, I don't consider that expensive. It gets a lot cheaper on individual stocks. I'll show you in a minute. I've got other examples here, but again, this is kind of an average time frame, and this allows us to get, the cool thing about it is allows us to get a pretty good width on our trade here, and we're collecting some pretty good theta. So all we got to do is really hang out between here and here and make money, right? And we decide when to pull it off. If $250 is your number, put it on, boom, take it off, right? If you're more aggressive, excuse me, you hang around, there is 5,000 max profit in here, and you just hang around later. Now, again, everything is relative to your trading comfort zone, your account size, your, I guess, knowledge of the trade, for lack of a better word. You need to know what you're doing. The longer you stay in, you're getting gamma build up and that kind of thing. But again, great trade, right? All right, so the next one is Amazon. This is a current trade that I have on in bias right now. And I do have a lot of people in bias in here. And I checked it before I came in here, and we're up like $135, right? It's not much, but I've got up to 1,910 on the upside and all the way down to 1,660 on the downside. That's a whole lot of width that I can move around in, and we're just collecting some theta there, right? So again, a lot of different variations on a trade like that we can do. We only did 3 contracts, and if you notice on this one, we actually structure this past earnings. I'm kind of leapfrogging over earnings, but we'll take it off before we even get to the earnings. We're just sitting here collecting some theta. So that's there again. Variations on the trade are just unlimited. So got one, or had one in Netflix here. It was bullish, and you can set it up bullish or bearish. What's going to, you see this T+1 line? It rises up here and it falls down here. What helps or hurts the trade? It's volatility, I mean, this is basically a directional trade. If you kind of close your eyes and squint, it's kind of like a debit spread, kind of, with positive theta. Don't get that very often. It does have some positive vega here. So this, we have to monitor it, right? But you absolutely can set it up bullish. It all depends on your view of volatility and how you structure the trade, where you put your strikes, where you put your expirations. So again, it is a great trade, and it does frustrate me when people say, I don't ever use those are boring or whatever. Well, that's because you probably don't really know how to take full advantage of it, right? So this next one, Johnson & Johnson, that was for 9 days. Again, everything is relative. Check this out. 79 cents, cheap, right? It's 275 bucks in 9 days. Everything is relative. I like that. This is not a lot of effort and heat on a trade like this. And I'll say this, for years, for a long time, I would only do these on low beta stocks. I wanted something that's not going to move and something that's going to stay still for me, and I just would be neutral, and I just sit there and collect theta, and that works. And that's kind of boring, right? Over the years, I realized that you can use these on just about any type stock if you know when to go in and when to come out and how to manage it along the way in in the volatility ebb and flow and cycle and the price movement, right? Big components of it. Here is I had this, I said bearish trading AVGO, and I thought people would laugh at me if I wanted to go bearish on AVGO, but here is the concept, because Broadcom it's a great stock, it's going higher. I'm not bearish on the stock, but can I make money on it? Sure, absolutely. They report earnings and stocks just kind of straight up vertical, right? And it's kind of, I wish I'd put a chart in here, but we're kind of reaching a little point. It could absolutely go higher. Well, on a trade like this, look, there's my break even up here, 309. So I've got a little bit of wiggle room. It can keep going up a little bit, but on the day that it does pull back, reversion to the mean, which would be in our channel, then I catch it down here. We get to some vol move. We're getting positive theta. This T+1 line goes up, and it's a great trade. So it is, although it is below and it is on the put side, I don't really see this as a bearish, trade, but that's where we would make the most money, is if we get a pullback of minimal amount, right? 5 points. And we have buffer zone up here, 5 points. So how do you get a directional trade that is a bearish, slightly, quote unquote bearish trade that has positive theta, which means it pays for itself, that gives you some buffer zone? You can't do it with a put. You get, your theta will eat you up. Debit spread typically is going, unless you're pretty far out, is, your theta is going to eat you up. This is the way to do it and take advantage of some volatility here, right? So that's another setup there. The next one is IBB. We all know the IBB. I'm looking, this one is range bound. We're looking for there's our parameters. Can we stay within that box for 10, 15, 20 days? Yeah, probably. If not, look how gentle the slope is on our T+1 line here. And again, these things have easy management, right? So, I had tried to go through with some different examples. Look at SPY here. That's 10 days in the SPY. Some people say, I like to use SPX. Some people don't want to use SPX for whatever reason. It's not as liquid, spreads are wider, account's not big enough, whatever. Here's SPY, 85 cents, right? Pretty cheap, up 180 bucks on 850. That's pretty good. Do we take it off here? Sure. Take it off, take the money and run, or hang around. There's more in there, right? Kind of like all of our other trades, we have to have parameters and guidelines and rules of what we expect it to do and when we expect to take it off. Got to have a target. Once you hit the target, take the money, right? So but again, there's tons of flexibility here. This is a newer trade on the SPX. We've got the range here up to 29.40. Guess what the all-time high is? 29.40, right? You can customize this any way you want to. Put that where you want to put it. I think 29.40 is gonna, I think 2900 is proving to be a pretty good barrier to get over. If we get over this and make a run, where's the next big barrier? 29.40. Are we gonna clear that? I don't know. So I've got from 29.40 to 28. There's 100 points. 28.40, 28.20. So I've got 120 points of room, up and down. And I'm getting paid 99 bucks a day for it. So I just kind of hang out, right? Again, very, very flexible. If you think, if we say, you know what, we want to design this where our upper end is 2,900, we put it back down here, it's cheaper, or we put it up higher, it's all in the setup, right? How, you tell me what you want it to do and I can show you what to structure it, how to structure it. So, lots of flexibility in the trade. But what I use it for, what I like to use it for is hedging, right? You can get a lot of volatility exposure for little cost. And we know that hedging, in general, hedging doesn't work, right? You have to do it, whether you like to or not. You hold your nose and buy it, for the most part. But hedging will give you the ability, using a calendar, will give you the ability to have an inexpensive or a less expensive hedge, by the nature of it having a pretty heavy, hefty positive theta component to it, and also a pretty heavy vega exposure. Now, it's not going to do as good as, say, a straddle or a back ratio or something like that. But if you guys remember when I was doing the straddles and the market started going down, and in the S&P, and they cost, I don't know, $120, $130 a contract. I mean, 10 contracts at 120,000 bucks, right? And we put some of those on, and some of them worked really well, but that's a lot. And unless you've got a pretty big account, a pretty big portfolio, and you can scale down, obviously, SPY, so whatever. But the point is, on a calendar, much cheaper way to do it. And think about this: how often in our let's just say S&P, on our S&P journey up, how often do we go up, pull back, 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 which is our reversion to the mean within the channel, ATR, Keltner, however you want to phrase it. How often do we do these things? Pretty often, right? Reversion to the mean, all that kind of stuff. You drop a calendar on the rise up, you drop a calendar down below, catch the move down, calendar down below, catch the move down, catch the move down, catch the move down, catch the move down, right? And that's beautiful. They're inexpensive and so forth. This is not the same hedge as Black Swan. Oops. Because your calendar works here and you made money. You made 15 grand on it or whatever, 10 grand, 15, 20 grand, whatever, but you closed it and we kept going, right? That's a Black Swan hedge. That's different, right? So this is not, there is no one stop, one size fits all, fix everything trade, right? Because in this kind of scenario where you have free fall, you do want a straddle or back ratio or something that's got a lot more oomph in the back, a lot of long puts, things like that. But it's going to cost you. You'll have negative 600 theta a day on something that's going to protect you on this kind of downside. And this happens, 97% of the time, and this happens 3% of the time, maybe not even that much, 2%. So you guys get the point. But we're pushing all-time highs right now. Great way to have a little backstop in there, right? And think about this: butterfly, great, get a lot of width, right? Butterfly's negative vega. That does not help you on the downside. You can get price cover, but you can't get volatility covered. So calendar's a great way to do it. So let me show you an example. Downside hedge on the rut here. This one, I don't know when I set this up. Rut's pulled back a little bit. Actually, we almost outran this thing, I believe, but it's come back down. This one is, it's about 11, 12 bucks. It's up about 900 bucks. But again, these are typically the type trades where me personally, I like to grab the low hanging fruit, get out and wait and try to do it again. That's just me. And we're going to go over different parameters around a trade and so forth. I'm doing a class on this with live trading and all that kind of stuff. That's what we're gonna get into all the details of that. But I wanted to point out and show you guys how flexible this thing is. So in another example, if we all use fib levels or voodoo lines or whatever we use, moving averages or Bollinger Bands, whatever we use, right? If you say, you know what, I think we're gonna be down here. Okay, well, this is gonna be a lot cheaper for you. Instead of 11 bucks, it's going to be $4, $4.95 or something like that. It's like any other trade. You're much further away. It's much cheaper. If it works, you got a lot more bang for the buck. Your risk reward's a lot better and all that kind of stuff. It's great. So you can design this how you want to design it, right? It's cool. Very, very cool way that you can maneuver this trade, right? So where are the opportunities? It's easy to use. There's, other than the different, you're using the same strike, using different expirations, but that's what makes it work. Again, remember, I was talking about back in the old days. Well, up or down, we want to buy this long option. Well, how are we going to pay for it? It's 28 bucks. Well, if we sell an $18 shorter dated option against it, then it only costs us 10 bucks and we still own the long option. Well, that's great. Then if the short, best case scenario, let the short expire and sell it again and let it expire and sell it again, right? So that was where it all came from, right? Well, now we've got, one click calendar, put it on, boom, done, all that kind of stuff. Really, really easy to use, totally customizable, very repeatable. You can dial it up or dial it down, as we've seen in some of these examples, depending on what you want it to accomplish for you. And typically it's lower commission. You saw in a couple of those trades that I only had 3 or 4 contracts, and that is mostly a function of price. I'm trying to keep the trade cost at 2,500 or 5,000 or 10,000 or whatever the number is, 20,000, doesn't matter. And I will do larger size in these as well, just because I get the width and I get a lot of huge vega exposure. And I'll say this, when you really need vega exposure, volatility exposure, it's great to have it, right? If you don't need it, use negative vega trades, and those would be, butterflies and things like that. So anyway, bullish, bearish, or neutral scenarios, and it's a cheap hedge, right? So you can tell that I am a fan, right? I've, again, that's one of the first, I used to do these on IBM when I first started. It worked for years and years and years, and IBM kind of doesn't trade the way it used to. And I've been through kind of, you get on the horse that's winning and you stick with it until it quits. And then we've all been through that with various stocks. Apple used to be a whole different stock 5 years ago than it is today. It's trading wise. But anyway, there are stocks out there that we can get on and just keep, riding and riding and riding. So, the structure of the trade itself is very easy, very straightforward. There's no add-on parts to this like we do on a lot of our trades. For example, I keep coming back to butterflies because that's the thing that pops in my head. I love trading butterflies, right? But we can do regular butterfly, we can do broken wing, we can do ratio fly, we can do all kind of stuff. And then you can add on, put some calls on the ends and dial your wings up and down, all that kind of stuff. There's no add-on parts to this, right? So I'm going to go over this in the live trading in the class. We're going to talk about it. There's no heavy indicators to use for this. Very straightforward. You know, I'm looking for two things: price and volatility. What is the price and what's the volatility? That's all I really need to know. And you know, that's it. There's a lot of opportunity in this trade. You got to know the structure of the setup and when to use it, when not to. Very critical. And it's like that with any trade. You know, this is just another in the, sooner or later you will have all of the option tools in your toolbox, and things will, and most of you may already be there, I don't know, but you know, when you start to know that there are different trades for different market environments, it's real easy to kind of plug and play and keep going with those. So that gives us the opportunity to spot, or the ability to spot the opportunity in the changing markets, so that we're not, you know, getting destroyed on our one type. We know how to do this, and you do it over and over and over and over, and it might work sometimes, and sometimes it doesn't, right? So keeps you from being the one way, you know, one trick pony trader, right? So again, you know, I know you guys can tell I like them. It's always been a core trade to me. I trade them on all kind of different vehicles and all kind of different variations. There are twists and turns on the trade, primarily from the rules around the trade and when to get in and when to pass. There are times to pass. This is a volatility sensitive trade, you know, and again, I'll come back to a butterfly example. You can use a butterfly pretty much anytime volatility wise. It has a low vega, you know, it won't destroy you. This won't destroy you, but it won't help you if you get in at the wrong time, right? But it's critical that you get set up right in the beginning to have it work beautifully for you, right? So I wanted to show one more example, and for you guys in bias, this is a live trade that we have right now. Now this is a little more advanced. We have one, two, three. We have 4 calendars. And I took a screenshot this morning. We were up $1,350. We've been in the trade for 12 days. And I want to, it expires, this is actually a little bit shorter date when it expires next Friday. We'll probably close this by Friday, and I think we'll be at $2,000 on this one by Friday. This one is a little more advanced. It's okay. Once you know how to do it, it's pretty easy, right? But look at our width here that we have. We have from 2780, there's 2880 to 2920, right? So we've got, now again, we've got basically four calendars side by side. We could daisy chain these together, right? We got 140 points of width. Am I worried about this? Nah, not really. We got tons of vega, we got tons of theta, we got minimal gamma, we got minimal delta. So again, this is a live trade. Now, as we know, well, if you trade these at all, this was pretty heavy in vega, right? Volatility actually came out a little bit at the close, and I checked, and the P&L was down a little bit from here. You'll see some fluctuation in it, but overnight, these things really start picking up theta. So, you know, it's a great trade and a great setup. Again, this one's a little more advanced. You got to learn how to do them. If you're not familiar with them, you got to learn how to do them first before you start trying to mix and match, put them together, and so forth. But I definitely want to show that because that's a real trade live right now that we have on in bias. So I want to give you 10 reasons why you should at least consider this, right? Simple setup. You really don't have to be too precise. This is not a laser perfect. Probably the biggest component of the trade working is volatility, right? And I can show you how to pinpoint the volatility, you know. Very theta friendly trade. I've shown you guys some examples and why, versus buying a debit spread or really buying any kind of options that are going to decay. We're buying the calendars, but you're not going to get that decay because you got the positive theta. Bullish setup, bearish setup. We can dial the risk up or down very easily by number of contracts, but also where you place your strikes. And we can use multiple trades just like I showed you in that last example. We started out on that one actually with a double, because if you've traded these at all, you know you have single calendars, double calendars, triple. That was actually, it turned into a quadruple, which is pretty rare, but it works. There's no reason not to do that. But they're easy parameters around the trade, super easy to monitor, and it's repeatable. Again, we just take it off and reset it and go to the next one, right? So let's talk real quick about any strategy, right? What do you need to know about any strategy that you do? Sorry, the cleaning people just came in here, knocked on my door, and walked in right in front of me. So sorry about that. So lost my train of thought. Any strategy, doesn't matter. Iron condor, butterfly, diagonal, long call, long put, deb spread, doesn't matter. Back ratio. Does volatility matter to this strategy? Got to know. Does it? Maybe. Is it very sensitive or a little sensitive or a lot sensitive? It can make a huge difference on whether to use it or not, right? So you got to know that stuff. Which expirations to use, obviously critical. Which strikes to use, which one's better? Do I use this strike, this expiration, that expiration? Why? When do I enter? Puts or calls, critical. What's the edge in the trade? If we line up all the trades side by side, we have iron condors and credit spreads and calendars and all that kind of stuff, all side by side. Which one has the biggest edge? Well, it depends on what the market's doing. It depends on the market. Is the market going up? It's going down? Is volatility going up or down? How fast is it going up or down? Lots of moving parts. And again, this will help you in any, if you go through these questions, on any strategy, it'll help you, right? What's the trade plan? And that I'm talking about, what's my goal for profit target? And typically, you guys know, in most of the trades, I like to get, 15, 20, 25%. That's the easy money. That's the low hanging fruit. Reach up, grab it, and go to the next tree, right, to grab the next low hanging fruit, right? We know there are a lot of tickets and things like that can have much more profit in them, but they don't work out as often. We want something that's consistent for a big bulk, big part of the portfolio, right? How to set it up, how it works, why it works, why it might not work, in different environments, and how to manage it if it gets into trouble. So to tie all that up, success in trading, we know if this was easy, everybody would be doing it, and then it wouldn't work. If everybody on the planet has it figured out, if there was an algorithm out there, if anybody could design something that just goes and makes money all the time, they all had to do is turn it on, right? It would work for about a week, and then everybody would have the algorithm, and then it wouldn't work anymore, right? So we know it's not easy, right? Why do most people have trouble being consistent? And I think one is discipline, but two, it is, or maybe even one is knowing, which strategy has an edge and which does not in the market that you are trading, right? And then probably number two would be discipline. But again, if you're, think about this way. We'll do a simple example. Like for an iron condor, you are selling premium, right? If you sell premium and volatility goes up, guess what happens? You can get more than you sold it for. If you sold it for $1, now you can get $2. Well, what does that do to your dollar? It makes it go down. So is that the best choice for that entry? No. You should be buying, not selling, right? So anyway, again, every strategy has different edges. You have to know how to spot the edge and when to use it and when not to. So all that being said, obviously you guys know I'm doing a class next week on this. We're going to do live trading. I always like to do live trading because that really gets down to in the weeds, and we have all of the what if discussions, and we obviously try to make some money. We'll set up trades and all that kind of stuff. But next Monday, we're doing the class on, to get into the details, because obviously on a short time frame like we've got now, this afternoon, there's 500 questions we just can't get into without spending 3 hours, right? So next week we're going to do a class on the core class on calendars, and then we'll do Wednesday, we'll take what we learned and we'll do 3 hours of live trading and try to get some good trades on and try to make some money. And I honestly think, you know, that the trading is worth the price of admission alone, just because to put it in action, you know, anybody can read it in a book. You can Google right now, just go on the internet and Google how to trade calendars, and oh, that looks pretty easy. It's pretty straightforward, right? Well, it is, but there are 500 landmines out there that you might step in, you know, and is it worth it to blow yourself up trying to figure it out? You know, it's not. So doing it live, we're all together answering questions and putting on trades and so forth, it enables us to do it. And last but not least, I know I sound like I'm trying to sell you something here, but wait, there's more. I really seriously believe that this, honestly, with us coming up an all-time high, this is a time. It's time to do it. So we'll do some questions, but I want to thank you guys for, you know, for joining tonight. You know, again, if you're familiar with calendars, you know what they can do. If not, you really should, you owe it to yourself to check it out, right? Calendar class next week, live trading. You've got to be able to have different tools in the toolbox. It surprises me. Some people will, you know, trade for years with one strategy, and I guess if you can make it work, that's great. I haven't seen a lot of that being the case, just from, you know, over the years. We're always having different markets and different volatility scenarios and all that kind of thing. So to me, having different, it's like trying to play a round of golf with one club, you know, so it's the exact same scenario. So let me get over here to the questions, and Diana, or if any of you guys can, Julia, if you can post the link up there, I will here in a second. Let me get through the questions. If you guys want to jump in here with me. So let me get over here to, let me get over to the questions. Sorry, I was flipping between. Okay, thanks, Darrell. Appreciate that. I've got different rooms open. I'm trying to make sure I get everything covered here. Scott, looks similar to a diagonal. It is very similar to a diagonal. Diagonals are more complicated, I think, and really can have a different desire for, you know, objective for the trade, I guess. So, and you know, I like diagonals. I use them all the time, but it's a variation of the calendar, which is the core trade. You learn calendars and you got diagonals down, I think. Let's see. How to find these low price debit spreads with low investment. One of the things that, and I know what you're saying, one of the things that determines the cost of the trade primarily is the price of the stock. So for example, on Amazon, I don't know if you remember that one we used, the debit was like 19 bucks. And if you were to use, I don't know, IBM or something, it'd be 75 cents. And that's fine, but this is one of the few trades that a lower cost is not a good thing, right? If you have a lower cost, say the calendar costs 75 cents. Well, the max profit is probably going to be $800 or something like that. That Amazon one that we did, or they have on right now, it's cost 19 bucks. The max profit's like 15,000. So you're paying for theta, you're paying for vega. That's what you want. So I don't go look specifically for lower cost trades because it doesn't help you that much, right? Let's see. Ron, how's it going? Yes, Ron. Okay, cool. Ron says, can it really understand how it makes money? Basically, you're buying a longer dated option, say $10. You're selling a shorter dated option, say for $5. Or let's make it easier to understand. We're buying the long dated option for $6. Uh, $10, sorry. So we're going to spend $10 on the long, and we're going to get 6 for the one we sell against it. So our cost is 4. We paid 10, we sold for 4, the shorter dated, so our cost is only 4. Well, what happens, the longer dated option does not decay near as fast as a shorter dated option. So the $6 option goes to 3 pretty quickly, and the $10 option goes to 9 or 8. That's where you're making the money. That's actually technically how it works. It's easier to show on on the like, for example, an analyst tab, but that's all you're doing. And again, this has been going on forever. People, I want to say in the beginning, but we want to buy some long dated options. How are we going to offset that cost? Well, we sell shorter dated against them. Okay, that sounds good. That works. Let me go over here. Noble, is this for indexes or there stocks? Yeah, we're going to do both. We will do both. We'll do both stocks and indexes. I like to do the indexes and primarily S&P, SPX. It's easy, very repeatable, very consistent kind of trade. You can take that same strategy. We can do it on any stock or ETF, anything we want. But sure, we're gonna do all like you saw in the examples. We've got one in Amazon right now, so it does work. Oh, good question. Let's see. So the question is around earnings. Yeah, so you got to be careful around earnings with the volatility moves, because you typically have, your front or your closer expiration volatility is going to be increasing as we get closer to earnings, right? The long does not. On the surface, that looks like a good thing, and it can be, but you have to know where in the level you are as it relates to volatility and where it might go. Any of you guys that were in the mentorship, Henry and I talked about this yesterday when we did a trading thing, exactly the same thing. So we're looking at where the current volatility is, where it might go, where we're selling that. Then we look at the skew. There's a lot of variables there. That is one reason it's easier to use indexes. You don't have to, or ETFs. You don't have to worry about that, the Qs or whatever. So it absolutely will work around earnings. You just have to be aware of the how to navigate earnings, because sometimes with the vol changes, it's better to pass. You have to know when to pass and when not to, right? Yes, this will all be recorded. This class is being recorded. The one next week will be recorded as well as the live trading. Sometimes some people can't make live trading. To me, it's still worth, if you can get the recording, you can listen to it and you know what the setups are. So if you get it like the same day. Jeff, what size account is required? That's the good thing. This is a very scalable trade. You can work on any size account, literally any size account. I used to do them very small. I'd put $1,000 in them, $1,500, very small. All the way up to the example the guy was showing us at the CBOE conference was, I think he had 4,000 contracts on the S&P. Was big. It was really big. Even for me, that was pretty big. I was like, wow. Let's see. Jimmy, yes. I forgot to mention it. Thanks for mentioning it, Jimmy. If you don't know, I use the Analyze tab almost exclusively. That's pretty much all. I look at charts, but I stay on the Analyze tab all day. I'm looking at the Greeks. I'm looking at the risk. I'm looking at the, risk reward, so forth. I will be going over that in the class, but also live trading. It is super helpful that you use the Analyze tab. And I don't get any, Toss doesn't even know who I am, right? I get nothing from them, but the Analyze tab is awesome. It really, once you get to be able to navigate it, it can step up your ability to, be consistent, for sure. Yeah, Rick, James, yes, yeah, it'll be recorded. It'll all be recorded. Text can, how's it going? No, bias members do not get a discount. I don't have anything to do with the pricing, so it's easy for me to say that, right? This is honestly lower price class. Most of the classes we do are higher, a lot higher. But this being a strategy class and live trading, I think it's pretty good, personally. And the other thing too, and I'm glad you mentioned that, because I literally have been trading the strategy for 30 years. So whatever the cost of it is, if you like it and you use it and it works for you, you're gonna be using it 30 years from now, unless they quit trading options. But there will always be a front and back month trade, and this is the core of that trade. That's, that's pretty cool. Let's see. Lewis, purchase bread and butter weekly and flexible diagonals. Anything new here? Yes, different. This is not, well, one, it's not diagonals. Diagonals are different trade. And these are not, this is not primarily a weekly setup. You got to know the core stuff. Anytime you get into any weekly strategies, whether it's condors or butterflies or anything, there's obviously a big added element of risk because of the time frame. We're going to go over the core type trade and how to adjust it into, or not adjust, how to make it flexible so you can use it in different scenarios, I guess is the best way to put it. Jeff, yes. I mean, just as with most of the trades, the question was, how can these trades go wrong? Two ways: price and volatility, right? There are pretty easy ways to keep parameters around that, and there's easy management techniques for that as well, right? So yeah, it's really straightforward. Akeem, yes, totally different. Question: is this class different than Bulletproof Butterfly? Yes, has nothing to do with butterflies. Calendar is a completely different structure trade. Apples and oranges, completely different. Ben, how do you calculate profit loss? You have your cost of the trade, and I use the Analyze tab. That's the easy. I was trying to think mathematically how to tell you, but the easy way is throw on an Analyze tab and look and see what your cost is $2,000 and your max profit's 5, and I'm going to get 30% of that. Whatever. I'm throwing out a number, right? I use the Analyze tab to calculate that. It's again, it's straightforward. It's very straightforward. Let's see. Out of money, call counter makes money, stock goes down, higher value. Danielling, out of the money, call counter makes money when stock goes higher, but Vega decreases. Yes, it can. And that's a structure of theta overriding Vega on the upside. And that also is a function of the speed of the vehicle, if that makes sense. You have to make, we make assumptions with every trade, right? And we have to make assumptions on where the price is going to be in what period of time to decide if that's the best way to structure it. But yes, the theta can override the vega on the upside, given some time. Sure. Jeff says, "My broker won't allow me to do counters against RUT or SPX." Jeff, that's strange. I've actually heard that before. Very, very rare. I've heard a couple of people have told me that. If that's the case, you can always switch to SPY and IWM. Works just as well. They actually work better functionally or mechanically because of got a lot more liquidity in the SPY and the IWM. The reason for that, some brokers not doing that, is the European expiration, and they look at those as two separate trades. And that's crazy. I don't understand why anybody would look at that. It's one trade, but you could close one. You could close the long and leave the short open, and it would, But 99% of the time, brokers will have no problem doing. I've used them in quite a few different firms over the years and never had a problem. But if you do, you can, on those, you could use SPY and IWM for sure. And Qs, use the Qs on the NDX. Let's see. Yeah, Mark. Yeah, that's what I was saying. The same thing on Danielle on the upside. Yeah, on the upside. It depending on how fast your volatility drops and over what period of time, your theta will catch up with it over time. And again, how far out of the money are you? All those variables make a difference in structuring the trade, right? Greg, a couple there. Greg, the question is, or Greg's question is easy to defend or you just get out? Both. They're easy to defend, but sometimes I just, here's the line in the sand. I'm out, right? And we're going to go over that in the class, but, and, I hate to say it depends, but it really does depend on where you are in the trade and what you think the vehicle you're trading is doing. Because think about it like this: if we're trading Tesla and Elon Musk, I think he's supposed to say something tonight. If he tweets something or says something, the stock gaps 40 points, I'm out. Not going to try to fight that. If stock just goes up 2-3 points a day, that's easy to defend, right? So again, it varies. It depends. Jeff, okay, yeah, all right. IW and SPY, yeah, okay, cool. JLP, haven't done a butterfly class. JLP, I've done a lot of butterfly classes. In our company store, there's a handful in there. At one point, I had like 32 classes in there. I think they've taken a lot of them out because they were older. I had a calendar class in there, but it was like 2012 or 13 or something. It's very old. So anyway, yeah, and if you want to contact customer service or something, they can help you out, or me. You guys can email me. I'm bad on email, I'll tell you that. I just got so much coming in every day. But Canoe, calendar on commodity futures, great question. I have never done that. I don't know. I know you can. I just have never done it before. Mostly because I don't feel comfortable enough with the underlying, not the calendar side of the future, the commodity, whatever commodity I'm trying to look at. I'd rather just do straight futures, but anyway. J or SPX calendar trades better than put credit spread trades. Yeah, they're totally different. Totally different trades. So that's real tough to answer. I prefer them, but I use a lot of put credit spreads, but it's for a whole different scenarios where I'm trying to set those trades up, right? And David, yeah, I'm not sure on futures. I honestly have never done them on futures. I should know that. I just never. Whenever I trade futures, I just trade futures more directionally. And good question. I will, yes. I always try to send, the question is, we send alerts out after the live trading, and I always try to. And as far as I know, I've always done that. I don't think I've ever missed any. Um, yes, I can do that. Absolutely. Let's see. Guru, I'm a newbie trader and have knowledge of very basic option strategies. Do I need to have prior knowledge of intermediate advanced options to benefit? No, 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 absolutely not. I think this is one of the most basic strategies out there. And I know a lot of people haven't looked at it because it doesn't. First, people do long options. I want to buy long call, buy put. And second, spreads. You know, I want to take that long call and then sell something against it in the same expiration. It becomes a spread, debit spread or credit spread. Do the exact same thing, take that long option, I'm going to sell something against it, but I'm going to do it on different expirations. It's calendar. It's almost identical to, you know, a debit spread or a credit spread. You're just doing it on different expirations. So answer is no. This is a very, you would get it. You would get it. It's a basic strategy. Joey, I would say this is novice to intermediate. It's not advanced. I would like, we probably will do an advanced follow-up later when we get into a lot more. I mean, you can do ratios, you can do all kind of stuff, but there's just simply not enough time to cover all that, not effectively. You know, I can skim over the surface and it's drinking from the fire hose and it take 4 hours, but I don't think that helps anybody out. So this is what the core strategy is. This is when to use it, how to use it, variations of that core strategy, but it's not going to be advanced. Absolutely be intermediate and absolutely be beginner, novice. No, we're going to look at different ways. I mean, you can adjust them or not. We can have easy parameters around either way. Some people, you know, some people like to, and I like to kind of adjust if I think it's going to work, right? I'll stay in, but you don't know if that's going to be the case until you get there, right? Because you don't know what's going on with the market and the volatility, right? Fall Crush. Fall Crush is laughing at my setup. That's actually my old office. I've got 6 monitors now and a whole bunch of guitars on the wall. But yeah, we had one of our old photographers came in and started taking pictures, and I was annoyed, I think, and say, you know, hurry up, take a picture. I'm right in the middle of something. So yeah, I do have my lava lamp there. And that on the wall is actually a girl that works here. His husband gets all this stuff, and it's an old Lone Star beer sign. Actually, kind of funny though. It's funny you notice that. All right, guys. Well, I need to kind of wrap it up here, wind it up here. I know there are a lot more questions, but we could go. You know, we could stay all night. And that's the good thing. You know, the good thing and the bad thing about it. There are the trade itself. Honestly, is pretty straightforward. I could show this to anybody that's only been trading weeks and they would understand it. That being said, there's a lot of things that, you know, it's like saying, well, here's a you know, here's a knife, it cuts paper, don't hurt yourself. You know, there's a lot of things you can do with it, right? So you need to know the parameters before you you know, again, you could Google it, and there's you know, on the internet, and it show you how to do it, but that's only part of the story. You really need to know when to use it, when not to, you know, all the different variations, all the structure. I'll do a complete step-by-step plan, step 1, step 2, step 3 of building the trade, and each step what is involved and so forth. But it's very straightforward, right? So again, you know, I wish we had more time, but we probably need to wind it up here because I promised I would keep this pretty short. And we'll talk about all of the, you know, all of the aspects of volatility and what we're looking for and what to avoid. You know, it's easy to find the things on any trade, you know, of this is why it works, but then people don't tell you, well, this is why it doesn't work sometimes, and this is when it doesn't work sometimes, and this is what to do when you get in trouble. You got to know that. That's part of it, right? So anyway, all right, guys. Well, let me wind up. I'm sorry if I didn't get to the questions. Again, we are going to we'll get back on the we'll get to the main class will be this coming Monday. Now it's got I've got from 5 to 7 Central blocked off. You guys, anybody that's taking a class from me, you know we're going to go more than that, right? We always do. I'll try to keep it. It will be recorded. I'll try to keep it. You know, maybe we'll do 2 hours and then some Q&A or whatever, and then we'll do live trading from 12 to 3 on Wednesday. So we take the class on Monday, let all that soak in Monday night, Tuesday, come in Wednesday all fresh, and we'll hit the ground running, and we'll try to make some money on some trades, right? In the meantime, this will be recorded. Darrell will have it up as soon as he can. If you have anything that you need to find out, you can call or email support at Simpler Trading, or you can email me, Bruce at Simpler Trading. Absolutely, doesn't bother me. I just don't. I've already got stacked up emails from being out and to the mentorship we just had, so it's going to take me a while to go through a lot of emails. But also, if you're in bias, obviously we can talk about this in the bias room anytime, and I'll be back in the main trading room on Friday. So with that, I apologize if I didn't get to your questions, but let me wind it up because I promised to keep this around an hour, and we're already gone an hour and 15 minutes. So I really appreciate you guys dropping in, and I hope this was helpful. Hope you learned a little bit, and I hope you consider thinking about the calendar as a strategy. It's a really good trade. You need to know it. And with that, I'll wind it up, and hopefully I'll see you guys next Monday. Thanks a lot, guys. I appreciate it, and have a great night.